Hello, peeps. We are the Prophets. I am Mr. Cheeze, and to my right, I have.
The chart doctor, you know what it is.
And today, this is our live podcast, our first actual podcast, in which we will be discussing on the topic of how to not be emotional while investing. Would you like to start off first, chart doctor?
Yes, I will. So, what I want to talk about is for market volatility, for example, volatility, the price going up and down, you should change your attitude towards the price volatility. Change your mindset of day to day volatility and learn to embrace momentum change of the market. If the stock price goes up, that's an opportunity for you to reach closer to your exit position, earn more money, and lock in profits. If the stock price pulls back and begins the downtrend momentum, you can use this opportunity to buy shares for a discount. What do you think about that?
I have a question. You said if the stocks keep going down,
Mm-hmm.
what if you buy it? What if you enter
Mm-hmm.
and it continues to keep going down? What would you do in that position?
In that position, I would only spend 10 to 25% of my capital per average. So it depends how much you know this company and how you know the pattern of the company. But so if you had $100, you can buy 25 shares at, for example, the price of $50. And then after you can buy it at, for example, if it goes down, you can buy it again at $35. So it depends how you want to edge out your price range. Like you can do after -5% or -10 if you want to do conservative, or if you like really want to like buy more, you could do like 2 to 5%. But that's when you only use 10% of your capital per share, similar like to dollar cost averaging.
Okay, so you said you want to do more research on it
Mm-hmm.
and then continue buying it
Mm-hmm.
if it's below the price that you bought it in, right?
Yeah.
And then you wait until it goes up again to exit.
Yeah. So for example, if it's 50, you buy it at 50. You have 5 shares. You're trying to buy 15 shares, right? So you buy your first 5 shares at $50, for example. It goes down to 40. You buy more. You buy it again for 5 more shares at $40. Then if it keeps going down, let's say the worst case scenario goes to $30. You buy another 5 shares,
Mm.
and then that averages you out to $40. And then the market, for example, it just happens to uptrend to $50. Then you make profits of $10, additional $10 if you instead of buying it all in at $50 in the beginning. So basically, it's really great because, like I mentioned, it reduces your mental emotions because you're not worrying about the price. If it goes down, you use that to your advantage. If it goes up, you make profits. You never go broke making a profit. You know what I mean?
Yeah. So in that situation, you wouldn't want to panic, sell or panic buy. You would be patient and calm, stay composed and calm, do
Mhm.
more research and gain more knowledge about the company within the span of like 2 or 3 weeks, depending on whether the market either rises or falls,
Mhm.
and then you would exit it when you made a certain amount of profit
Yeah.
percentage wise.
Yeah.
Okay.
That's dollar cost averaging. That's a strategy that you can use. And do you have another strategy that you want to talk about?
Yeah, so I believe that the most important skill in order to have to not fall victim to emotional investing is by, like you said, attaining credible knowledge about the specific company and stock in which you're about to invest in. By that I mean gaining a basic level understanding of the risks involved that can heavily mitigate a great deal of emotional investing. So emotional investing can often come when investors see higher stake rates than they originally thought of in the beginning. For instance, so like during a bull market, when the market goes up massively, investors can often see the market opportunities because you just see the green, you just see the plus arrows, which means which doesn't necessarily mean you should buy at that point, Because if it's going up, that means at any certain time it could also be a bear market. So in that point of time, you'll have to do more research, like say like the financial reports or earnings of that company within that week, and see how they're doing to see if they're whether or not they're gonna be if they're gonna continue being in the bull market where it shoots up, or say they're not doing that well, like that the sales is only temporarily because of, like, for instance, like say it's December and you invest into a toy company, it's gonna keep going up because it's Christmas and you see a lot of parents buying
I
children.
understand. Oh, okay, I see.
But say since it's Christmas is only for so long, so like for like 2-3 weeks it could keep going up, but then there could be a drastic, like you don't know when either. There could just be a drastic bear market where it just goes down.
The trade war, right?
The trade war. So you wanna buy it at that level before it goes up, and then sell it before it goes to a bear market again. So you wanna buy it low and then basically sell high. Exactly. So like just basic stuff.
Yeah, that actually brings me to my next point, because when you buy, you have to make sure you're not buying at the uptrend. Like, you don't want to buy at the top.
Definitely.
So what I like recommending is looking at the yearly lows and like doing the dollar cost averaging strategy that we were talking about. So you have $100. For example, let's make it easy. $100. You buy it at the yearly low at $25. So maybe the stock costs $25 for a stock. So you buy one share, and then it keeps going down. You keep buying more, and then eventually, because stocks never go down to zero. You know what I mean? There's never a stock that goes down to zero unless you didn't do your research, like you said earlier, not putting in the work, and you already know what this company can provide for the people. So, like I said, you just have to know what you're buying, and the yearly lows are very important because that's when you're guaranteed. Like, it might seem like you're buying a loss, but if you really done your research and you know the company and you know what they can provide for the customer, then it should be fine. You could just buy more, and as it keeps going down, keep buying more. Eventually it will come up. It will have its highs and lows, and when it's time to get the high, that's when you can sell your exit position, and then you can learn a lot and then gain experience from making money using this strategy. Is there anything else that you would like to add?
Staying patient is a virtue during that time.
Yes.
Because you don't know when it's gonna shoot up to. Say it could be like 2 weeks. It could be as little as like 1 or 2 days.
Mm-hmm.
Maybe it can be a couple months. Maybe even more than a couple months. You never know. So you gotta keep getting your knowledge. Keep doing your research so that you can be more confident and not panic or have fear, which really signals, or which really pushes you to emotional investing. Panic and fear, those are the two certain main ones.
Fear of not knowing what you're buying. You need to know what you're buying. You're not buying the stock, you're buying the company.
And
Also, okay, like, you can keep going?
yeah, I also like to mention that investors can often see market opportunities or learn about investments from investing sources such as stories, friends, or families that may compel them to test new waters or try to obtain gains from profitable investments due to bullish market conditions. So while all these good news can excite these investors, you can't jump on that wave unless you're there first. So you can be that investor. You don't want to be that investor where the wave is going on already, because the market entry that which you want to join it is already gone. It already went up. Unless you caught on near the beginning where it's gonna continue rising up, you don't want to jump on that, because the profit margins are already gone from the people who already began riding that wave. So unless you're either starting that wave or you're near the beginning of that wave, you don't want to get excited and be like, oh, I want to get on this as well, and then join it, and then see that you barely gained any profit margins because it already happened already. You're too late, basically. All that good news you heard that might excite you, it's too late already. You're gone. You're like it's far gone from that.
My question is, how do people know before the uptrend or before the trend starts? That's my question.
Like you said, well, not like you said, like I previously mentioned, you will want to keep looking at that financial reports, or the financial reports, analysis, and statements. The current ones. If they release any, especially if you're in the specific field of, say, like you're in technology and you're reading about Apple, and they're releasing something, a new product, and
5G.
5Gs, for
5G
example,
iPhones.
5Gs or something like that, something new, you wanna
You're
buy
hopping
as
into
much.
it
Exactly,
before
you're
the
hopping
other
onto
people
it.
know.
Yeah.
The fundamental analysis is very important, like he said. You're doing the research before people hop on. You already know
Beforehand.
what's happening before people know what's happening.
Beforehand, way beforehand. So continue doing research and continue getting new information is pivotal and key into entering the new wave before it even hits.
Exactly. So like if July they drop a quarterly report like Apple and they say in 6 months they're working on the project of 5G iPhones, and then 6 months later they announce it, but you already knew. No one else that didn't read the fundamental analysis, they don't know, but you knew already. You had 6 months in advance to know that. You had the money ready to put in the shares before the 6 months started.
Exactly.
So that's why you have to put in the work. And
Exactly.
you can know all this stuff about, you can know like all these news about the articles and the stock, but you just really need to know this company yourself before the news. You already know this company before the news. All that is just icing on the cake. You already know what's happening. That's what we're trying to get to the point across.
Mhm.
So, do you have any other strategies that you want to go through?
Another one, let's see, another one would. Okay, so I talked about the bullish market before riding on that wave. Well, getting onto that new wave. Inversely, a bear market comes along the corner, and that will come. It will indefinitely come because it's not always gonna be a bullish market where it's
It would be
always
too
gonna
easy.
that would be too easy, like you said. Excuse me. So a bear market is gonna come where it starts going down along the corner. You don't know when, but you would probably want to know how. And not knowing how is not that important either, because you just gotta. It's just something that important for investors to follow and understand. Because since a bear market did hit, again, it's gonna be a bullish market that's gonna hit sooner or later. So while that bear market hits, you want to keep paying attention to it to see how low it's gonna hit. And again, you can buy in. As long as you buy in at the certain low point, whether it's either dipping down and you can either buy in there, or when it's starting to go up again at the very beginning when it started to go up again, that's when you want to go.
Drawing trend lines.
Yeah, drawing trend lines. He's more into
Yeah,
the charts, so
I love
you
the
can go
charts.
into it.
But for example, if there's a pattern that it's going on, you can draw a line. If it's long term, like daily interval times, you could draw a line using the drawing tool on TradingView or StockTwits or Webull. You just draw a trend line. If it breaks, you'll know that it's going down the downtrend. So that's when you can use our strategy, the dollar cost average. It's not our strategy, just a lot of people do that. It's a very common strategy actually. And then you can use that as an opportunity to buy. You just keep buying partial amounts so you don't have to worry if it keeps going down. You know that it goes down on the downtrend, and you can keep drawing the downtrend line. Then when you draw the uptrend line and it breaks the uptrend line, that's when you can keep drawing the downtrend line now. You can draw the downtrend and see when it breaks, and if it breaks to the upside, that's when you know it's going to start the uptrend, and you can plan your target exit. So,
Like you said, for the people who don't know what the dollar cost averaging is, just like for the beginners, it's like the basic meaning is that it's a strategy where equal amounts of dollars are invested at a regular predetermined interval. So for instance, during the bear market, investors are purchasing shares at a cheaper and cheaper price. And for the bull market, the shares previously held in the portfolio are producing the capital gain. So that's where you're getting your profits. During the bear markets, you want to keep buying it at cheaper price, and during the bull market, that's where you make your profit margin. That's what the dollar cost average is. Where you put in the dollar and the amount of dollars you're putting in, you're getting it back during the bull market when it's rising up.
Because
And how much profit
you're
it's
using the
making.
averages. You're lowering the
Exactly.
averages.
Exactly.
You're buying the dips, so your price keeps going down. And when it's like you said, when it's time for the bull market, that's when you cash out.
Mm-hmm.
That's when like the other investors that don't know the strategy, they're buying in at the uptrend, but you're already buying at the down. You bought at the bottom of the downtrend, so you're actually lower than them, unless the people buy at the downtrend. But that's very hard to find, unless you've been doing the charting analysis. But that's what I'm saying. Dollar cost averaging is very simple. Like you don't have to do a lot of math or worrying about when the bottom is. You don't have to
Exactly.
find the perfect bottom. You just worry about your life. Just do dollar cost average, and you can just focus on other things rather than just always charting. Because I know sometimes that can get kind of like be tiring for your mental.
Hold on one second. I need to plug in the battery because we're about to run low.
Also, I want to talk about using a stop loss. It is a great idea to use a stop loss order to put a cap on your losses, a capitalization on your losses. You're minimizing your risk involved. So, for example, of a downtrend scenario in the market that you're buying, you have 100 shares of XYZ. That's not a real stock. Just XYZ, bought at $10 per share. You would place a stop loss order at $8 per share. And then, for example, the XYZ drops down to 5%, $5. Because of your stop loss, your 100 shares will be sold as the stop loss was triggered at $8, limiting your losses to only $2 rather than $500. $200 rather than $500. Because your stop loss is at $8 instead of it going back down to $5. You minimize your risk involved of losing that much money. If this is for people that do not really like dollar cost averaging, I know some people don't like it. We're just trying to give you as many scenarios or different strategies for you to implement. You could just find the one that you like. You don't have to follow our strategy. You can follow anybody's strategy. Follow one that you're most comfortable with. So,
I want to mention something. So you can do whichever strategy you think is like works best for you. However, you should also keep in mind that the dollar cost averaging is recommended by many successful investors like Warren Buffett, Benjamin Graham, Robert Kiyosaki. He's the author of Rich Dad Poor Dad. And he also mentions that money is made when a product is bought. So during a stock's bear market is the optimal move to capitalize and buy in order to gain the most profits, because with the correct knowledge and certainty of low risk, and these are the situations which one can come up on top and be rewarded handsomely. As long as it's certain that there will be a bear market up and coming, one must also be very patient when it comes to dealing with these kinds of risk. So the slight amount of emotional investing here can have one's effort and time be stopped for nothing. So you always want to keep doing your research and keep doing your studies within it. And you always want to keep keeping certain that if it's in a bear market, you want to know for sure that it's gonna go to a bull market.
yeah, for example, GoPro hasn't went into the bull market yet. If you bought a lot there, it could have went. It's still going down. So you have to know the company. You have to know its potentiality. You have to know that it can grow again before you do this strategy. Don't buy in a stock that doesn't have potential and it stays at the bottom of the price list, of the price action.
If you do not do research or gain a credible amount of knowledge, then that is emotional investing. You're at that point gambling.
You're gambling.
And gambling is not certain. Gambling is a high risk. You always want to be at a low risk. That is investing. That's the definition of investing.
So I also want to get to my example of an uptrend scenario just for my bulls. For first step, you have 100 shares of XYZ bought at $10 per share. You would place a stop loss and again at $8 per share. But what if it's a bull market? So it keeps going up. It's still going up, right? then XYZ happens to climb to $13. It doesn't hit your stop loss. You can cancel your $8 per share stop loss and recreate a new one at $11 per share. But you bought at $10 per share, okay? Remember that. Therefore, if the stock falls at or below $11, you're still coming away with some profits. This will reduce worriness and concern, similar like to dollar cost average. And then you would make money regardless. Like they said, no one ever went broke making profits. Would you like to share anything about that? The stop loss, like, what's your opinion about it compared to the dollar cost average? Like, do you like dollar cost average better, or do you think stop loss as your strategy?
Stop loss is like whatever, just because like you don't gain
Yeah.
as much profit from it. So I think it's like a whatever
Yeah.
strategy. I think the dollar cost average is really the technique to go, strategy to go for most investors, where you
Beginners
can capitalize.
to advanced, any
Exactly.
level.
Everyone uses it, so you know it's like the most optimal strategy to use. But however, another technique that was mentioned during my research was called the diversification techniques. This often diminished the emotional response and impulse to market volatility, and emotional investing giving investors confidence in their allocations across the market. So in most normal market cycles, using a diversification strategy provides downward protection. In order for all this to work, the market would have to move in unison. Only then the diversification gives you some coverage. So again, this is proving that the dollar cost averaging is the best way, because diversification, you would have to keep doing research on multiple different fields. And I was talking to this in someone to Mickey 556.
What's up, man?
He what's up, man? He gave us holdings of how many of what shares he had, and I told him specifically he had like four different companies in like 4 different fields, and I just told him like, you want to stop doing that diversification, because you don't have that certain amount of knowledge, it's hard for you to have that certain amount of knowledge for you to be able to
Handle that many company industries at once.
Exactly.
You should only narrow down to 2 to 3 depending on your capital. The less
exactly
capital you have, you should focus on less industries. But don't think of it as a bad thing, because you know those 2 to 3 companies down to your mind. You know that from just closing your eyes, you already remember everything.
you want to be an expert at one certain field,
Yeah.
1 to 2 certain fields,
Rather
in which
than
you have
5.
certain knowledge of companies, rather than 5. Like,
5.
'cause even think about it.
How many reports do you have to read? 5.
How many?
Like
That's a
5
lot.
reports.
That's a lot of reports.
Versus 2 to 3, like you said, it's better
Exactly.
to just have 2 to 3.
Yes.
And then you know it more. And then it's better, like you said, I remember you brought it up before we did this podcast, that it's better to do the industries that you like, that you enjoy.
That you're genuinely interested in,
Mm-hmm.
so that you can keep doing research on that without getting bored and without thinking, oh, I don't want to do this anymore, because you're genuinely interested in that topic, in that company, in which you will be like, oh, I'm interested in this. You read about it, and then you think, I can make money off this. It's a win-win.
And then you never get bored reading about it.
Exactly.
Like, if you don't like accounting, like stocks or bank, you're gonna be super bored reading the 10Q 10K. You're just gonna knock out when you read it. Just do, like, if you like esports, read about esports. If you like cars, you can read about electric cars like Tesla stocks. See how they're doing with their Gigafactory. Or Ford, if they're gonna make electric cars in the future, if that's gonna bring them stock revenue, earnings per share. Earnings per share.
GM2, General Motors, Ford, what is it? Chrysler.
But not only that, I also want to say that if you have 2 to 3 industries instead of just one, and you have all your money in it, if one industry goes down, you still have backup compared to only one industry going down. Then, like, for example, if one industry and one company goes down 40% and you only have 100% of your capital in it, you're going to be freaking out when it's 40% down. But if you have 3 different industries, one in the food industry, one in technology industry, one in solar and energy, then, or gas, you don't have to worry if one goes down to 40%, because you only have 30% of capital in that stock, so it won't hurt you that much. You don't have to worry about it when you sleep. You can actually sleep at night.
That's the case where diversification will be more benefactory to you. That's that one case.
Yes.
unless the market, like I said earlier, unless the market is moving in unison, then you won't gain as much as having like 5 shares into electric or like electric technology companies and then 5 shares into like General Motors. Like you won't gain as much profits because say you have like 100 shares into like different electronic companies where you're spreading them out evenly and say they all go into a bullish market, then you get your profits right there. That's gonna be your money maker.
So thanks for tuning in with us this week on the Profits Podcast. Today's topic was how to not be emotional while investing. Subscribe, comment down below your opinions and thoughts on this topic and whether you agree or disagree with what we had today in this discussion. Thanks for watching.
Leave a like. Don't forget to leave a like. We are the Profits.
Smash the like button. Thanks for watching. Have a good rest of your day. And let's get this cheese.
Let's get this cheese.
Get this cheese, Mr. Cheeze.
All right.
Stay locked in.
Peace.